Welcome back. Well, stable for the indices. The Nifty is just about flat. We have the Sensex, which is also just about trending with a 0.13% cut. So it is largely a day right now. At least the frontline indices are consolidating as we speak. And we have the Bank Nifty, which is underperforming. Nonetheless, let's talk a little more about the markets. We have Somnath Mukherjee, who's the CIO and the senior managing partner at ASK Private Wealth, joining in. Mr. Mukherjee, hi, welcome to the show. Well, let's start with the entire banking NBFC space and, the fear that maybe tightening on unsecured lending is now probably going to weigh in terms of the financials, the loan growth when it comes to the entire financial space. What is your view on it, and what are you telling your clients this morning?
At the margin, actually, it is good for banking stability. RBI is being ahead of the curve on this, not dropping the ball. We've seen pretty breathless growth in the personal loans space over the last couple of years, in fact, 8 or 9 quarters now. And it is always good to take pauses and corrective actions while we are still at the growth and build out phase rather than trying to address a problem once that's occurred. So from a stability perspective, it's great, and it is good for the banking system as a whole. Individual banks and individual lenders, including some of the larger NBFCs, will have to work out their own strategies in line with this. Some of them will need to raise incremental capital sooner than they would have expected. A couple of them have actually fortuitously already raised capital in the last 2 to 3 quarters, so they should be fine. But some of them may need to hasten their capital raising plans. But key to lending, and we've seen this since 2008 financial crisis, key to discovering value in lenders in any lending platform is that the stability comes first, and then you can add value on top of that. And this clearly is a case of RBI being very cautious in terms of ensuring systemic stability. And so while there will be a little bit of blip and a little bit of tremors in some of the stocks, both banks as well as NBFCs, where the growth on the personal and unsecured loan side have been very high. But by and large, over the next 2 to 3 years, I think this would have been a good start as far as staying ahead of the curve regulatorily is concerned.
All right. So would you then, say that a lot of the money which would have otherwise looked at NBFCs as an investment option, but who want financial exposure or exposure to the financials, are backing names like asset management companies? We're seeing a decent move come by in a lot of these AMC stocks. You have UTI AMC, HDFC AMC, HDFC AMC, in fact, is at the high point of trade as we speak. And a lot of these insurance companies as well. So, I mean, there are more avenues to play the financialization theme than just NBFCs and banks. Do you think these could be beneficiaries of that?
Even without this, the play on India financials has been for quite a few years now, a bit broader than just lenders. Insurance companies, asset management companies, and wealth management companies all together have also got a significant amount of play in the markets, in the listed market space today. So will this result in a little bit of intra-sectoral rotation away from lenders into some of these fee-generating, non-lending kind of businesses? Possibly. Especially because a number of them, especially insurance companies and asset management companies, have lagged in the last couple of years due to various reasons, several of them systemic in nature. So some of it in terms of capital rotation could well happen. But the broader India financials opportunity has always been of more than just lenders. It's lenders plus a whole range of other alternative financial institutions that are not lending in nature, but fee-based revenues in nature.
Okay, well, since we are talking about the entire financial space, Mr. Mukherjee, just wanted to ask you about a couple of the rate sensitives. 2 sections of stocks which have been doing extremely well is one, the real estate space, where there's so much positive news about festive sales in the city of Mumbai. And the other section is the entire auto space. A lot of these auto stocks are at fresh 52-week highs. Hero came out with a very strong indication in terms of festive sales. What is your sense on both of these counters? What do you like in terms of the real estate as well as the auto space? Do you think it's good, it's up for more gains from here on?
Right. So I'm actually a little bit curious why people still call them rate sensitive, simply because we've seen in the last couple of years a fairly sharp, at least for this year, a very sharp increase in interest rates across the world, and India has not gone untouched by that. And some of the traditional so-called rate-sensitive sectors have done rather well in that scenario. That includes real estate and a range of high-ticket consumer discretionaries, including automobiles. So a large part of it is on account of the fact that one, underlying consumption demand, especially at the top 5 or 10% of the population, remain very strong. And we don't see too many indicators that militate against that trend yet. And secondly, India's tightening on the monetary policy side has been rather more mild compared to what we have seen in the rest of the world, certainly in the developed world, in the US and Europe. That's again thanks to some fairly nifty management by RBI, plus our own intrinsic factors at play. As a result of which, we haven't seen the sort of shock on yields that, say, the US Treasuries have seen. So currently, we seem to be at the peak of the rate cycle, globally as well as in India. Nothing in the horizon suggests that rates are going to go up from these levels significantly. So if indeed these sectors are rate sensitive, then they should continue to do even better, given that we are probably peaked out on rates. But I think it's a bit of a flashing, sort of loosely worded thing to say a bunch of sectors are rate sensitive. A more fundamental factor driving interest, demand, and hence stock prices in these sectors is underlying confidence and consumption trends, and those two remain extremely strong. Especially, as I said, in the top 5 or 10% of the consuming population, where demand is across the board very strong, which includes automobiles, which include high-end real estate, and a range of other discretionaries.
All right, Somnath, thanks a lot for joining in and giving us your views on a whole host of sectors. This time around, our discussion, unfortunately, was limited to the financials or rate sensitives around that itself. But look forward to having more conversations with you. Take a short break, come back, focus on the markets and a bunch of individual stocks which are on our radar.